Do you want to know how you can build your own strategy and be able to profit from it? Every day, many people get involved in receiving trading signals from others, which is a mistake and eventually leads to loss. But how can we create our own specific trading method? Hi, I'm Tradiology, and today we're going to answer this important question and build our own strategy together. Please subscribe to my channel and hit the bell before watching the rest of the video. Alright, let's get to the tutorial. What exactly is a trading strategy? And do we absolutely have to have one, or not? Well, a trading strategy is a set of actions that we have written down in advance and are fully prepared to execute from start to finish. These actions include having a method for entering trades, capital management, and applying important psychological techniques. So, a strategy is not just a technical method on its own. It is a combination of technical analysis, capital management, and psychology that we can call a strategy. As for whether we absolutely must have a trading strategy or not, hearing the answer to this question from the audience requires a more prepared mindset. If I want to say it briefly, the answer is yes. But in my opinion, if you are a beginner trader, you might think that trading without a strategy is much more exciting and that there's no need for rules and structure. In my videos, I try to build the mindset that explains why we need to have a strategy. Someone who enters or exits trades without any rules is definitely doomed to failure, no doubt about it. As I mentioned in previous videos when talking about probability, trading is a game of probabilities. And in probability, if you don't set strict rules, at some point, you will fall. Because in every trading method, there will be times when consecutive losses occur. And the only thing that helps us and prevents those losses from destroying the account is having a precise strategy. So now you understand how serious this subject is. Now I want to go over the step-by-step process of creating a strategy. First step, choose a technical entry method for yourself that is not too complicated and has good repeatability. For example, imagine this chart is in front of us and we want to enter during corrections that have two legs. In the second leg, when we see a good candle, we enter. This is your technical point of view. Just take this idea and backtest it in past market data, and if it works, it becomes your technical method for entering trades. Now in the topic of capital management, there are some general rules that are unavoidable. For example, one rule is that you should not increase your risk per trade, because eventually it leads to big losses. Besides these general rules, you should also create some personalized rules for yourself. For example, if at the end of the month you were profitable, keep 30% of that profit aside, so that if losses occur in the following month, you won't have serious concerns about it. Or for instance, if you take 2 losses in one day, don't trade again that day. Or if you lose 5 times in 1 week, stop trading until the next week. Then review your trades and see if you made a mistake that caused those losses, or if you did everything correctly. As for psychology, you must have written rules. For the factors I'm going to mention, try to write a sentence next to each one explaining how you plan to control it. First one is fear. Has it ever happened to you that your strategy gave a setup, but you were afraid to take the trade? Or that your trade got close to the stop loss, and you panicked and made the huge mistake of moving your stop loss? I can't even describe how terrible that is. All I can say is, if you do this, stop trading immediately. Pay close attention. When you increase your stop loss, your reward-to-risk ratio decreases, and that leads to losses, which is bad. Next is anger. What is your reaction if you lose several trades in a row? Do you get angry? That's right. This can only be controlled by mastering psychology and understanding probability, which I talked about in this video, and will explain more deeply in future videos, and also through gaining experience. So in the beginning, don't be too hard on yourself. Next is greed. When your trade hits, take profit, but you don't close it, thinking that the profit will keep growing. A very useful solution is to analyze past market data and record how many times the price would reverse if you didn't close your trade at TP. By observing this, you'll realize that many times, the price reaches exactly your fixed TP level, and if you don't close the trade due to greed, the price goes toward your stop loss, and this causes you to fall into psychological traps and lose your ability to manage trades. You must write down all of these points in your trading plan and follow them during trades. Okay, let's do a quick summary of what we talked about today. We talked about trading strategies and said that every trader must have one. A trading strategy includes a technical entry method that is developed through backtesting. The next pillar is capital management, where we explained how to manage profits and losses. And the final part is trading psychology, which is developed through experience, proper education, and reading books in this field. These are the main pillars of a trading strategy, and if you have them, you'll make significant progress. Thank you so much for staying with me until the end. I hope today's training was helpful for you. If you liked the video, please like it. And to stay updated with future trainings, make sure to subscribe to my channel. Goodbye.